right, guys, Fuquan Bilal here, PFREI, a passion for real estate investing. We're back with another great episode, and I have the man, the myth, the legend, Jeff Spiegel from Spiegel Accounting. So the reason we created this platform primarily was for attorneys, whether they were foreclosure attorneys, business attorneys, SEC attorneys, accountants like Jeff, to come on this platform and share their experience and knowledge and give you guys some type of guidance on accounting or legal information in real estate. So we have Spiegel here, Mr. Spiegel from Spiegel Accounting. I've met this guy a few years ago, and I was at an event and I had the opportunity to speak, and when I got off stage, he had actually spoke to me about some things that I was talking about that I needed to be aware of as far as from an accounting perspective. And from that day, I had the utmost respect for him for teaching me right off on the spot some things that I needed to brush up on and understand more for accounting. And since then, I've been consulting with this guy and trying to extract as much information as I can, from him, from these events. So, one of the questions I want to ask you, this platform is for people who's passionate about real estate. What are some of the things that, whether you're doing note investing or real estate investing, just getting started, whatever, that you need to be aware of from an accounting perspective that you see most people make mistakes on?
Oh, well, that's a big question because it's pretty vague. So, because we work with a lot of the private equity funds that are doing lending, real estate syndication. And then within lending, you've got a traditional fund doing first mortgages, maybe second mortgages. And you also have some funds buying non-performing loan pools and working those out. And someone buying maybe tax liens and doing that kind of thing. And so each of them have unique tax rules related to each thing, so can't be specific. But what we do is we end up working with a fund that's from the start helping them to structure the fund right and gets their private placement correct with all the right language in there for disclosing to the investors. And then we also help with the accounting based on what the fund is doing so that the rules are applied appropriately for generally accepted accounting principles for the audited financial statement, as well as the tax methods for preparing the tax returns. And you also get K1 that goes to the investor for them to provide for their tax return.
Yeah, the K1s is actually something that's very important. If you are running a fund that's, for any fund investor know that the first quarter or the last quarter going into the first quarter is very, very important to make sure you get those K1s out to your investors on time, in time. So that was the biggest challenge for me the first couple of years of my fund, making sure that I got the K1s out to the investors before the deadline, because a lot of investors like to file, they don't like to extend, they like to file the first go around, and you have to be ready. And I see a lot of people in our space struggle with making sure they give that information and be prepared to have information. So what are some of the things that you can say to give advice on how to make sure by January 10th or somewhere around that time you have your K1s available? What are some things
January
you tell?
10th, man, you want a miracle.
I'm trying to get it when it's 10, so.
So we have all the pressure
Some
in the
people
world.
get it the day before it's due. That's crazy.
We get all the pressure to have them all done. Typically by March 15th, we try to get them done by the end of February because the individuals need them for their April 15th deadline. But there are cases where the information that goes in the return isn't available until after the deadline, so you'd extend it. That would be a situation where maybe fund to fund, you're waiting for a K1 from another fund, and they don't get it to you timely. So that kind of delays those. Yeah. But generally for the other funds, we're trying to be in touch with the clients ahead of time so that we know that their accounting information is going to be complete. So we touch them before the end of the year, looking at their tax information maybe as of September to make sure that everything's in line, things that need to be fixed, caught up, so that we can get the information for the end of the year by the end of January, so the K1s can be delivered by the end of February.
That's awesome. That's awesome.
So they have plenty of time to get their individual done.
Yeah, I know we touched a few times on note accounting with the phantom equity and everything else. This is always a big thing for me to talk about. And we're here now actually at the Note Expo. You see we have our badges on. This is a great event. It's at the end of every year, and I come here to learn a lot of stuff and connect with people like Jeff to kind of learn a little bit more tax strategies and other strategies. But we talked about this note thing where we talked about phantom equity. Let's just break that down a little bit. So I buy a non-performing first mortgage for a $50,000 unpaid balance for $10,000, and then the homeowner, we modify the loan or set up some type of payment plan where they're paying again. And some people use different, some people modify, some people use a different strategy where they just collect interest and set a term for 5 years and don't collect any principal. What are some of the things you see in a space where no investors make the mistake while not doing proper accounting in that type of situation?
Right, so modification, specifically what he's talking about, has rules for tax rules. If you make a significant modification, you have really a new note. So you have to report the new note, and then you book your phantom income or your gain. So in his example, $50,000 note, $10,000 you purchased it for. If I modify the note, let's say I do a due note at $30,000 with a lower payment amount over the same term, now I've significantly modified it. So I have to book the new $30,000 note and book a $20,000 gain between the $10,000 and the $30,000. So I have phantom income. That means I have income with no cash, because now I have another note that's just performing.
Yeah.
So to solve that, the fund like Equiquan has to manage that phantom income. So they may have to take some of those reperforming modified notes and sell them, liquidate them, and get enough cash to fund the tax liability that might exist from that.
Yeah.
Would be a good example.
Yeah.
Okay.
That's something that, in the beginning I had to wrap my head around it, because I'm responsible for this gain,
Right.
By modifying it.
And the same situation exists if you have an REO, foreclosed. If I have this $50,000 note for $10,000 and I foreclose and the fair value of the property is $50,000, I have to report the fair value of that what I received on my books and book the gain on that $40,000 differential. So because I'm now sitting there with an asset, I basically got my note, $10,000 note paid back with a $50,000 asset.
Yeah.
Now I can either hold it or I can sell it and get the cash or whatever, but I have to book the gain at that point in time, not later when I sell the property.
Now that you mentioned REOs, it's funny you mentioned that, because we actually talked about that before, where basically, is the REO registered in that state? Is the fund licensed in that state? Are they filing a tax in that state for REO as well? So,
Right.
what is your take on that?
Okay, so state filings come up. There's a lot of multi-state filing requirements. One would be something like this, but many of them would be, if you have out-of-state investors, the out-of-state investor in your fund, let's say you're in New Jersey and all your activities in New Jersey, but I'm in California, I'm in your fund, I have to file in New Jersey. I have to file for the income you earn in New Jersey, even though I'm a California resident, because your fund's in New Jersey.
Yeah.
So there's some out-of-state requirements when you have out-of-state investors. As far as the having notes all across the country, interest we typically goes back to the home state, corporate states, and so it's all get reported in New Jersey. But if you had real estate in that state, now you have to start filing in that state. So you might have rental activity or the sale of the real estate gets reported to that state. As far as licensing requirements, anytime you're in another state, even with just owning loans, there's many states that require licenses.
Absolutely.
And there's a few specifically that you definitely have to have. Some of them I'm not sure how they track it, but licensing is a problem for you when you have multiple states, for sure.
Yeah. We leverage, the servicers in the states that we have to get licensed in, that we don't have enough portfolio there. We sell those off and liquidate them.
Right.
Just so we can manage the whole process. I mean, regulation is everywhere. If you want to be in this business, you definitely have to play by the rules, especially if you're raising capital from investors. You want to make sure that you're protected.
Many rules.
But yeah, you're based in California, and you do a lot of traveling. You have investments in Vietnam, all over the place.
We're based in California. We have probably 100 private equity funds across the country that we work with.
Yeah.
And help them with all these things.
Yeah.
I have a private equity fund myself, not in the real estate lending side. It's in financing movie rights.
Yeah,
pretty
you
cool.
telling me that. Yeah.
And then I have this nice investment.
Yeah, in Vietnam.
Retirement investment in Vietnam, so I can
That's
spend
cool.
time
That's cool. And you're out there with 4 or 5 months out of the year.
Yeah, I'm trying to get there 4 months out of the year.
Yeah.
But nice little beach town. And
yeah,
really
I know.
nice
I Googled it and I saw it. I'm like, wow,
Yeah.
this doesn't look like Vietnam. This looks like,
It's really beautiful.
really
place.
nice. The bathrooms, everything laid
Everything's
out.
clean.
That's
it's
good.
Americanized place.
Yeah.
It's comfortable.
So, of course, you have a staff that
And inexpensive, too.
Of
And the
course.
best part of it is we have a coffee shop. All the drinks are organics. We have Vietnamese coffee, which is amazing.
Yeah.
And you have these yogurt drinks and fruit drinks and juice drinks. And
That's all. You guys got to check it out. Plug it. Come on. Tell them the site to go to. Tell them the site.
Kami Riverside Resort. That's Khamy. Riverside Resort.
Yeah, I was pretty impressed with that. I had a conversation with him one day. He's like, hey, go online, Google it, check it out. I'm on my way out there now.
Yeah.
I still can do business. We're in a different time zone, but still can reach me.
Very
He
true.
communicated, still spoke to me and everything
true.
else. Give me a few leads that I followed up on. I really appreciate that. But I just wanted to take the time out to speak to you and
appreciate
get a
it.
few nuggets and share this information with people. If you want to give them your website or some way how to contact you, for business.
Yes, you can
that'd be great.
contact us, spiegelcorp.com, that's SPIEGELCORP.com.
Thank you. It's another great installment of the PFREI Passion for Real Estate Investing here with Jeff Spiegel from Spiegel Accounting. You guys have a great day.
Thanks for having me.
So it's good. I mean, this is just live. The phone
Okay.
ring, the horn.